Hello everyone. In this presentation, we shall discuss, is international trade always good for the economy? Here, we'll see how international trade can increase economic growth. This is the first of the three parts of the presentation under Open Economy Macroeconomics Basic Concepts. For the other two parts, click on the link given in the description of this presentation. So, the question, is international trade always good for the economy? The answer to that is an emphatic no. It's not always good for the economy. Few decades back, when global international trade was in its infancy, specifically between the developed and the developing world, international trade was overall a positive sum game. After the globalization phenomenon related to international trade has matured, calling international trade as always a positive sum game will not be correct. Today, international trade can have all three states. It can be a positive sum game, a zero sum game, and a negative sum game depending upon what countries and what state we are talking about. Even if international trade, when it was really a positive sum game, there were and are bound to be winners and losers. So let's first see how the exchange rate, which is a very basis of the international trade, behaves between two economies, in this case US and China. Let's take an example, when there is not much of international trade going on, or in other words, the demand of the two countries are pretty much satisfied by the supply, um, by the production supply within these countries. So in that case, let's assume that the amount of credit required for production of X amount of goods in US is quite less when compared to the amount of credit or monies required to produce the same amount of goods in China. Or in other words, the productivity in US is higher than the productivity in China. And so since the demand is pretty much satisfied in this case by the internal productions, we would say the exchange rate of US would be gaining in strength overall compared to the exchange rate in China. Now let's bring the international trade into picture. How? In this case, let's assume now that the demand in United States is not, the internal supply or internal production in United States is not able to facilitate that overall demand in United States. So that would mean a trade with China in this case. So now China would be shipping in goods and services to US, and in return US would be sending in the dollars or the money to China. Let's see how the players stack up. And these players would play a role in all the three parts of this presentation. So there will be the outsourcing companies in US, companies who outsource the production of goods and services to China. There will be the companies in US who will export goods and services to China. Yes, some will be there in US as well. There will be workers who will be working in the outsourcing companies in the US. There will be workers who will be working in the exporting companies, that is, companies that will export stuff to China. And there will be some workers who will be out of job because of all this process. And finally, we have the government and the central banks of US. And yeah, let's not forget the most important ones, the investors and the bankers in this entire process. Now, who are going to be the players in China? First, there will be the export companies in China who will be exporting goods and services to the US. There will be companies who will be importing goods and services from the US, and the companies who will be producing goods in China to cater to the domestic markets in China. Then there will be workers working in the exporting companies in China, workers working in the importing companies, that is the companies who will be importing goods and services from the US in China, and workers who will be working in the companies that will be catering to the domestic markets of China. And finally, we'll have the government and the central bank of China. And yes, financial institutions like in the US will be also there in China. So we shall overall club them together. So initially what happens? I will request you to check the presentation on modern monetary theory to see how government spending and monetary support leads to optimum utilization of resources in the domestic economy, especially when it's closed domestic economy. Now something similar happens, but this time because the economy is open and international trade is going to take place, this will happen in China. That is, because of the lack of resources in China, the optimum utilization of resources because of government spending in US will start to happen in China. So, when the government in US increases its fiscal deficit, or for that matter monetary support by the central bank, the demand in US will rise. And this demand will be catered to not by domestic production in US or very little by domestic production in US, but this demand will be catered through by the production increase of supply of goods and services from China due to the international trade. Also, because the cost of production of goods in China is low, in spite of the lower productivity, prices in the US market will also decline due to cheaper imports. Now let's see how the trade will flow. China will be sending in goods and services to US and at the same time would be sending in kind of deflation or lower prices to the US. Thus, this will allow the government to increase its fiscal deficit even more because of the lower prices. Also, this will be a two-way flow. How? China would also be importing some goods and services from the US that are probably high-tech in nature. Also some raw materials, agri products that China can import from US, and then in return it will be sending some of the same dollars that US shipped over to China. Now, because of the reduced inflation levels in the US domestic economy as a result of cheaper goods imported from China, the government can now afford to increase the fiscal deficit. Fed can monetize this fiscal deficit or the government debt. So, the government increases its fiscal deficit, thereby increases the debt level, which the Federal Reserve can buy indirectly maybe from the private participants in the financial markets through freshly printed money, which it can credit into the government account. In modern day, it's also known as QE or quantitative easing. Another way in which the government can fund its deficit, increased deficits, can be through the debt, which can be bought by both domestic and foreign investors, including the Chinese investors, of course, who will credit the money in the account of US government. Also, let's understand how the capital flows will occur. So, since China is sending in the goods, US is sending in the dollars, that's the current account. In the capital account, US will be kind of sending in the debt, the US government debt, the corporate debt, and its equity of the US companies. And Chinese investors would be buying in using the same very dollars. So let's talk about who the gainers are and how they stack up in US. Biggest, I would say, the gainers are the financial institutions. Why I say that? There will be increased financialization of the economy as there will be more debt in the economy. Less inflation would mean more money can go into the financial assets. Also, the productivity of the companies will increase overall because of this. And overall, there will be more companies in China as well as in US, so the nature of companies in US would change. Also, the outsourcing companies in US would be gaining tremendously on account of their increased profitability and higher equity prices. And then the export companies in the US, even they would be gaining because there would be more demand for their products in a new geography that is China. As new markets are opening up, they'll be gaining as well. What about the workers? Well, even the workers for that matter, workers who will be working in the export companies of US, the companies that will be selling goods to China, they would be gaining as their growth potential would increase, and also they would be buying cheaper products than what they had been before. So overall, their living standards would be higher. Then workers working in the companies who are outsourcing stuff to China, even they are good enough because the prices of products have come down, their salaries might be kind of stagnant. So overall, their living standard is higher than before. Yes, there will be some workers who would be out of their jobs because of this. Some workers who would graduate to the companies who will be selling high-tech stuff to China. Yes, there will be some workers for that. For them, it will be a good deal. For some workers who will be working in lower-end jobs now, in service industry, for example, and workers who are out of job, for them, it will not be that great a deal, obviously. However, because the prices of products have declined, US government has increased its fiscal deficit so the jobless workers can get the government support, and coupled with the fact that the prices have declined, and if they own some equity or some other asset in terms of real estate, those prices have shifted higher. So I would say even this category of workers may not be better off, but at least initially would overall not be worse off. So in total, because of the initiation of international trade, more or less most of the participants in United States have overall gained, or some of the participants have overall their living standards have remained the same, but on total things are much better. Now let's take a look of what happens to the players in China. Of course, the financial institutions have gained like before. Now the companies which are exporting goods to the US, obviously it's a new business for them. The opportunities are great. Equity prices are shooting up. It's a great time for them. Also, the companies who are importing goods for them from US, they are getting newer opportunities. Companies who are producing goods for the domestic markets of China, their market is gaining new grounds, and it's a great time for even them as well. What are the workers? Well, the workers working in the export companies, it's a good time for them. They're getting good money. Newer opportunities means more employment opportunities. Their pay scales are rising. The workers working in the import companies that are importing goods from US, again, they are getting more and more opportunities, and it's a good time for them as well. And finally, the workers who are working in companies that are catering to the domestic market of China. For them also, the growth potential is higher, more employment opportunities, and a great time. So overall, great thing for almost all the players in China. And in the US, as we discussed before, great things for almost all the players in US. So, what's the conclusion in this part 1? At the time of initiation of global international trade, it's a positive sum game. There are winners in US, China, internationally, and overall. The biggest winners are the financial investors and bankers, the companies in US and China, followed by workers in China, and large parts of the workers, I would have to say, even in America, gain because of their higher living standards and more business opportunities. Yes, Some workers in America will lose, but those out of job workers and workers who will be moving out to a lesser paying job, their living standard would still be maintained, but the government support due to high due to the government that can afford a higher fiscal deficit and a lower inflation, ensuring their living standards that is close to what it was before. So thank you very much for watching this presentation. Do subscribe if you like such content and comment in case of any queries. And do check the part 2 of this presentation to know what happens as the ball of international trade rolls further. Thanks a lot.